Hello, my name is Brian Overby. I'm known as the Options Guy, and I'm the author of the Options Playbook. Welcome to Options Guy TV. On Monday, we talked a lot about the fact that over the last 8 earnings season or quarters that we've had earnings, we've seen the market do extremely well. We've seen it have a fairly decent run up. And basically, those run ups would usually head into CPI reports or the Fed speak, and those rallies would get stopped. Recently, what we've seen is that those rallies have kept going. We got a little bit of excitement in the marketplace, and I'm going to start by showing my screen, and then we'll talk a little bit about the trade that we looked at on Monday. But right now, you're looking at a chart in the S&P 500 index. And we talked about the moving averages, the fact that we've had some good numbers during earnings season, but then the market has sold off. But in this instance, one of the things that we haven't had in a while is our ducks in a row. And by ducks, I'm talking about moving averages. We see the 200-day moving average is now below the 50-day moving average, which is now below the 20-day moving average. So if we look at that, that's usually a sign of a healthy marketplace, a more bullish, quote unquote, than bearish marketplace overall. Now, the downside that I see here is that this move has kind of been parabolic in that markets usually don't go straight up. And we've had a very strong bullish move overall. And if I look at the 45, actually, I put my cursor up here around 46.25. That's that high in the S&P 500 index. I'd be a little nervous around that. Whenever you see a parabolic move and you're trying to break through a recent new high, that would be an area of resistance, I think, to the upside. I also find it interesting, too, the S&P 500 index usually pays a lot of attention to the 200-day moving average. And we do see here that we broke through it. But right here, we came right up to it, and then we sold off a little bit on the downside. So we've already broke through this high. We're pushing up towards this recent high. That was way back. When is this? This was trying to get the date up here on the 29th of March in 2022. So those are some areas of resistance that I would be a little nervous about. We talked about the fact that during earnings, we've always had companies that have been reporting fairly decent numbers, a little bit of a run up in the markets, and then be a little bit nervous about a sell-off in the market. We also talked that a lot of people have stopped the recession talk. Not necessarily stopped it, but not as scary as it used to be. The VIX we saw come all the way down to the 13 level. And we also had some other things that are showing a little bit of a complacency in the marketplace with the VIX down at that level. AAII came out with their bullish and bearish indicators from retail clients, and the bulls are at all-time highs. That means a little bit more complacency in the marketplace. People are starting to feel good about the markets. As soon as we got off our show on Monday, Goldman Sachs came out and said that they're reducing the probability of a recession. And I think they put that probability at a 20% chance of us having a full-blown named recession in the marketplace. So all of this has fueled the market, and we've had a very strong market just over the last couple of days. Some of the banks came out. Schwab had a really good day. That's one that we want to look at and focus on. Today we have Tesla and we have Netflix that are going to be announcing after the close. So we're going to actually look at a trade on Netflix. We kind of highlighted that on Monday's show. But before we go too far, let's go back and look at what happened with our long call spread or our vertical spread that we looked at in the S&P 500 index. So I'm going to go back and look at the trading tab here inside the Trade Hawk software. Now, as far as the SPX is concerned, 45.65 is where it was at. I took a screenshot last week of the paper trade. And we always call them paper trades because nothing's really meant to be a recommendation. We're trying to learn here. We're trying to go through different strategies. And we have a lot of Option Guys TV. We're going to have a lot of shows. So we're going to look at a lot of different strategies. One of the main ones that we're going to focus on is just doing long call spreads and butterflies and those type of things in the S&P 500 index. But then we'll also go and, do one-off trades like we're going to look at on Netflix here. So the paper trade from last week, when we did it, the market was at 45.20. Now we see the market at 45.67. So strong move up. We were talking about a potential adjustment if the market went down. We had a 1-week trade. We have one adjustment that we'd want to make, and we'd only make that if our forecast or where we wanted the market to go was opposite as planned. So we're very deep in the money. That 45.10 call option is the one that we bought, and that right now is trading at 60.92. We see it down here. I clicked on that right there, and that actually made it go into our order ticket down at the bottom. So here's the 45.10 option, and it's trading at $60. So a very expensive option contract now. And then we sold the 45.15. Now remember, that was an at the money option contract. It was trading for right around $20. And now that's trading for $56. If I just focus on the bid, that's trading at $56. So net, it's kind of been all over the place, but the market right now is at a limit price, at the mid price right now of $45. Now, if you want to trade this and we've initially entered the opening trade, what we would want to do now is, and I'll close this out. Let's just start from the beginning here. So 45.10 is where we started. We had a buy at the 45.10, a sell at the 45.15. That was the initial trade. We paid $2.95. Right now, the TradeHawk software is showing us at a mid price of $4.65 or 70 cents. It's a 5-point wide spread, so the maximum is $5. Don't want to stick around to just try to make 25 or 30 cents. So at this point in time, we would enter a closing order. That simple. Go in instead of buy to open. We are now going to sell to close the leg that we bought, that we were long. There's many different ways that we can say it, that we owned. Now we're going to make that, and it's got to be a closing trade. And then on this one, we're going to buy to close. So in this, I don't have the position on, so it won't let me do it. Okay, so as far as that position is concerned, we were long the 45.10. We were short the 45.15. We now need to buy to close the 45.15 and sell to close the 45.10. If we do that, you'll see that this will now become a credit at the midpoint, and we're highlighting that right now, and it's jumping all over the place, just like the SPX will, mainly because we have such expensive option contracts that the bid-ask spreads are fairly wide. I would probably put this in at a limit price of 470. I think 470, I've seen that enough, and I've just let it sit for the day. And if it didn't fill today, which I would expect to get a fill, there's never a guarantee whenever you're trading at the midpoint, and especially when you're looking at something like the SPX, which is a very expensive index and has very expensive option contracts. If I look at that trade, I would just let that work, and I would let it work throughout the day. But I'm not too nervous about the market because we got another update today, and if it didn't fill today, I would try to just close it tomorrow. It'd be that simple. Okay, so that was a simple trade, and trades are easy when the market goes in the direction that you would like it to go. Now we have Netflix and Tesla announcing tonight after the close. So let's go and look at Netflix. And whenever I'm doing an earnings trade, one of the biggest things that I want to, or areas that I want to start with, is what does the marketplace expect the move to be after earnings? Now, I'm going to highlight that we are on the July 21st expiration, which is this Friday, 2 days away. During earnings season and with high volatile option contracts, we see the at-the-money vol here at 146%. And inside the TradeHawk software, we actually highlight the at-the-money IV, which is around 145. So we got a very expensive option contract on a fairly expensive underlying. It's not the SPX, but it's a $475 stock. Once again, we're looking at a $20 option contract on the at the money option. What the marketplace always likes to look at, and this is where you hear quotes a lot from reporters. Somebody from the Wall Street Journal calls up and says, what's the expected move on Netflix? All you do is go in and you look on, and I usually would just take somewhere near the mid, but we'll just round off a little bit because it's not an exact science by any means. So the bid we'll say is around 22. Over here, the ask is 21. So we're looking at $43 if we bought the long straddle at the money. Guess what the expected move is? $43. And a lot of people will just turn that into a percentage basis, and hence that would be the quote that you would see in the Wall Street Journal or on CNBC. This is the expected move for the stock after the earnings announcement. Now, it's not 100% true, because when you look at the expiration date, that's the expected move before or by that expiration date. So there's really another day in there. When you're announcing on a Wednesday after the close, you have all day Thursday, all day Friday. But, that's just a little bit of fluff. So they still like to call that the expected move around in earnings. And that doesn't have any regard to direction. It doesn't mean that the market's going up that amount. It doesn't mean it's going down that amount. If you think of it, when you're looking at earnings and using the options marketplace to see what it can tell you, you can kind of think of it as an over-under in the betting world. I don't like to put necessarily betting and options together, but there's a lot of math behind entering an option trade and also entering a bet on any type of sporting event. But the over-under would be, let's say we're looking at a football game and the score is supposed to, both teams are over-under, the total points would be 50 points. Well, you place a bet. Do you think it's going to go over the 50 points, or do you think it's going to go under the 50 points? And you make that decision, and then you place your bet in the casino or wherever you place it, or DraftKings takes their VIG, and away you go. And that's the concept. Okay. So our most likely scenario in the options trading world is you have this big event that's called earnings. What is the potential move on the underlying stock? It's not always accurate. A lot of times with the over-under, lines will get blown out and they won't even be close. But it gives you some hint based off of the order flow, the people that are buying and selling those at-the-money option contracts, what they think that expected move could be. If you do not think that it can move 43 points, and we'll just keep it nice and simple on the math, well, that means that if you're looking at a long straddle, well, then you'd sell that straddle as opposed to buy that straddle. And that means you're taking the under. If you think that it's going to go more, then you're taking the over. Now, I'm not going to do a long straddle. And I personally think that long straddles or short straddles are some of the hardest things to do around earnings. You have this one big event, all that juice is priced into the option contracts, and I usually just stay away from it. That's the one time I actually wouldn't look at doing a long straddle. We'll address some situations where you might want to think about it here on Options Guy TV. But with that said, I want to know what that expected move is, because I'm going to do a more advanced trade that's going to be centered around that expected move. And today I looked at just Netflix in general with a $43 expected move. And that put us, if you added at the time when I looked at it, it put us right around on the upside, the 524 strike. All right. So the 525 strike is going to be about where the expected move is at. Okay. Once again, it's not an exact science. I just want to emphasize that. But I'm going to pay attention to that because I want to be somewhere around that expected move with my trade today that we're going to look at, which is a butterfly trade. And it's going to be a very simple butterfly. I thought about doing something a little fancier, trying to bring in a net credit to the account. But it's as simple as I looked at it and I didn't find it that interesting. So these options are expensive. The market is in a kind of a bullish mode. So we're going to just take a shot at it in Netflix. That simple. It's a low cost trade that if we don't get it, we're just going to move on. And we're going to take advantage of the fact, the reason why we're doing this is that we have extremely high implied volatility. We have 2 days remaining to that expiration date. And what we would like to see is tomorrow, after the announcement, implied volatility to come off, get a day's worth of time decay. And of course, we'd like to be correct on our forecast. And if we are, this is the one time I kind of find butterflies interesting, because if you're correct on your forecast on a butterfly, you want time value to go away. And that's the way that you want to look at it and approach that trade. Okay, so let's set it up, and then we'll take a look at it. So I'm going to clear the trade down here that we looked at, the paper trade from last week, 480. So 425, we said that is that's what the marketplace thinks the underlying stock could potentially move if it moved to the upside. You can flip this trade and you can do it exactly the opposite way on the downside and go down about 43 points on the downside. Today, on our paper trade, we're going to be bullish. You decide which way you'd want to go with it. So I'm going to buy the 525. I'm going to sell the 540. So we're going to be 15 points wide. So if I click on the bid here, it will put a sell in. And then we're going to go 15 points higher, and we're going to buy the 555. And so in this instance, I'm going to click on that. And now we have it only puts in one contract inside the order ticket. A true butterfly, we would actually put 2 contracts in. And once we do that, it will give us the midpoint price on the butterfly. Once again, we have fairly wide bid-ask spreads. Around in earnings on a fairly expensive stock. Well, they're not too bad. This one's 15 cents. That's a dime in here. We got about 20 cents on the 525. But when you have fairly expensive option contracts and you're looking at doing a strategy, a lot of times it helps to add legs in order to get a better, quote unquote, fill price or something closer to the midpoint on that spread. So in this instance, we're doing a butterfly spread. It would be a long call butterfly spread. We want the markets to go up. If we bought just the way out of the money option contract, the 555 strike, we'd be paying $3.10 for that. In this instance, for the whole butterfly, we're going to pay 67 cents for every 1x2x1 butterfly that we do. That would be $67 plus commission to put that trade on. And that's going to be our maximum risk on the trade. And in this instance, if the market does open up, a lot of times this thing right away, especially with 2 days remaining in expiration, could be favorable. Now, I'm not looking to make the 15 points. That would just be that expectation you just need to get out of your head. That means that if we did this trade on expiration, the market would have to stop right at 540. Right at expiration, you're hoping to do that after Netflix. So once again, I'm not looking for a home run. And if you get the home run, that means you stuck around with the market at 540. I always like to say you should get the stupid award for that. Even though you did really well on the trade, you should have been out of the trade well before that. Right? So I'm looking, if I can get a doubler on this, if I could sell it for 120, if I could sell it for 130, realistic expectations on the butterfly trade that I'm putting on, I wouldn't mind trying to get $3 for it. That would be great. And if it's going in the right direction in a slower fashion, well, heck, I would stick around and I would consider trying to get a little bit more on the trade. All right. There's not really going to be an adjustment to this trade because it is so short term. The adjustment would be that we would just close it out. If the market did open down and there was still some value in this, I could sell it for 15, 20 cents, I would do that. And I would just get out and, move on to my next trade. And once again, this is a very speculative trade, mainly because we're doing it on a in the news stock like Netflix, part of the FANGs, and we're doing it around their earnings report. So that's going to be the paper trade for this week. With that said, if you have any questions, which I should ask for a little bit earlier in the show, but please do put them in the comment section, and I'll try to address anything that you might have. It could be on the S&P 500 index trade that we looked at, the good old SPX, or we talk a little bit about Netflix. Try to keep it on topic with the trades that we're looking at today, and I'll be happy to try to address them. So let me see if there's anything that is showing up inside our trade here. All right. So, all right. I do see one. That came up. Let's take a peek at that one. Max says, hi, Tesla is announcing earnings. Would you like to do this trade on Tesla? Well, the same thing kind of applies, right? We have an expensive underlying. We have a high volatile trade. I would consider looking at something like this on Tesla. Now, once again, you don't have to be bullish, or bear. You don't necessarily have to be bullish on these trades. If I was going to be bearish on Tesla, if I wanted to, I could just look at it the opposite side and use puts and use the same type of rules. I'm going to look at what the expected move is. I'm going to try to center it around that, and I would be looking to do it on the downside. And I don't want to spend a lot. That's the biggest thing. 67 cents. I would like to pay 50 cents for it, but the market's at 67. I think that's a fair price on it. But yes, I could definitely do it on Tesla, and I could be bullish. If I'm bullish, I'm going to do this same type of concept and look at the call side. If I'm bearish, I'm going to do it with puts and use the same type of math and formula to put together the put side. All right. Any other questions that we have? Going once. All right. So that's it for this. Oh, one just popped up. Okay. Let's see what this Max has a follow-up. Could you explain a bit how the exit would work? For example, the stock gets to around 550. Okay. All right. So if I do have this trade on, and the only real downside I would say about the Netflix and the Tesla is there's still going to be some juice in these options on Thursday, and then you have Friday to trade. But if the market did run up towards that, let's say it shot through your lower strike, it went more than the expected move right away, which is 525, and it ended up right around that 550 level. Ideally, we want it to be at 540. That would be our best case scenario, closer to that expiration date. But if it did, then we're going to just close out the trade. And if it was at that 550 level, I would just think bottom line is if it hits 540, I'm going to close the trade. A lot of people might be disappointed in that. They look at it and guess what? I only made $1 or $2 on the trade, and the maximum that it's worth is $15. And this is where I'm talking about realistic expectations. But if it hits that level, I just want to close it. I want to take whatever profit I might have on that trade, and I just want to get out and move on because I don't want it to keep going and blow past. If I got to that 550 level and say I didn't close out at the 540, I didn't get that opportunity, or it could just gap open, right? That could be a scenario that could happen. Well, then we want to go in, and once again, we're going to want to sell to close. We're going to want to buy to close, and then we're going to want to sell to close. And we're going to do the exact opposite of the trade that we put in, Max. That's exactly how we'd want to get out of that trade if we did it. And once again, the market's moving a little bit. It's at 70 cents now. All right, well, that's going to be it for Options Guy TV. We'll be back on Friday, and we will be able to see what happened with the Netflix trade. And we're already out of the S&P 500 index trade, so we'll come up with something new on Friday. Make sure you have your questions ready, and we'll try to answer them on that show. And thanks for coming, everyone, and hopefully we will see you this Friday at 11 a.m. Eastern Time for the next Options Guy TV. Thanks for coming.